Ever wondered why one month houses are selling like hotcakes, and the next month, sellers can't get a single offer? The reason might not be about the house, the neighborhood, or even the economy. In fact, it could come down to a single number: interest rates. And understanding how they work can be the difference between overpaying for a home and finding the deal of a lifetime. Let's break it down, step by step, for beginners. Hi, I'm a real estate investment advisor, and for over 10 years, I've been helping people understand the real estate market, from first-time home buyers to experienced investors. And here's something I've learned: you don't need a finance degree to make smart property decisions. You just need to understand the basics, and today, we're talking about one of the most powerful forces in real estate: interest rates. Now, before we dive in, let's clear something up. When we talk about interest rates in real estate, we're usually referring to mortgage interest rates, the cost of borrowing money to buy a home. They're influenced by your country's central bank rate, but what matters to you is how they impact what you can afford, and what the market is willing to pay. So, how do these rates actually affect real estate prices? Let's go through the first way. 1. Mortgage affordability. Imagine you're buying a home for $300,000. At a low interest rate of 3%, your monthly payment might be around $1,200, excluding taxes and insurance. Now, if that interest rate jumps to 6%, your monthly payment could shoot up to $1,800 or more. That's a $600 increase every month. For many buyers, that jump is a deal breaker. It means fewer people can afford that same home at the higher rate. And when demand drops, sellers may need to lower prices to attract buyers. On the flip side, when interest rates are low, buyers can afford bigger loans without paying more each month. Suddenly, the $300,000 home becomes affordable to more people, and in competitive markets, prices can climb because demand is so high. In short, low interest rates equals more affordable loans, equals higher demand, equals prices often rise. High interest rates equals less affordable loans, equals lower demand, equals prices may drop or grow slowly. This is why you'll often see a surge in home sales and prices when mortgage rates drop, and a slowdown when they rise. If you're new to the market, this is the number one rule to understand: the interest rate doesn't just affect the cost of the house, it affects the cost of your loan, and that cost can change your buying power overnight. Now that we've talked about mortgage affordability, let's move to the second way interest rates affect real estate prices. Let's look at the next point. 2. Buyer demand shift. Think of interest rates like the green light or red light in the real estate market. When rates drop, it's like a green light for buyers. People rush in to lock in those low rates before they go back up. When rates rise, it's a red light. Some buyers slam the brakes, and others step out of the market entirely. For example, imagine a young couple saving for their first home. They've been told mortgage rates are at a historic low, say, 2.9%. Suddenly, their monthly payment for a $250,000 house looks doable. They hurry to buy, and so do thousands of other couples. The competition drives prices up because there are more buyers than houses. Flip the scenario. Interest rates spike to 7%. That same couple now finds the monthly payment too steep. They decide to keep renting, along with many other would-be buyers. The demand drops, and sellers start lowering their prices or offering incentives just to attract attention. That's how powerful interest rates can be in shifting buyer demand almost overnight. 3. Investor activity. It's not just home buyers who are affected by interest rates. Investors are, too. When borrowing money is cheap, real estate becomes very attractive to investors. They can buy rental properties, flip homes, or invest in commercial spaces with smaller monthly costs, increasing their profits. Low rates often mean more investors enter the market, competing with regular buyers. This extra demand can push prices even higher, especially in popular cities or areas near job hubs. But when interest rates rise, the math changes. Rental property owners see smaller profit margins. Flippers face higher holding costs. Some investors shift their money into safer, interest-based investments like government bonds or high-yield savings accounts. The result: fewer investors competing for properties, and in some cases, lower property prices due to decreased demand. So whether you're a first-time buyer or just curious about the housing market, remember this: interest rates don't just influence your decision. They influence everyone's decision, from families to big investors. And that collective behavior is what moves the market up or down. Let's talk about the fourth way interest rates affect real estate prices. 4. Refinancing and selling decisions. When interest rates are low, many homeowners choose to refinance their mortgage, meaning they replace the current loan with a new one at a lower rate. This saves them money but also means they're less likely to sell their home anytime soon. Why? Because they now have a great deal on their mortgage, and moving would mean losing that rate. This reduces the number of homes for sale, tightening supply, which can push prices up. When interest rates are high, the opposite happens. Fewer people refinance, and some even delay selling because they don't want to take on a more expensive loan for their next home. This can keep supply higher, slowing price growth. 5. Overall market confidence. Finally, interest rates affect something less visible but equally important: confidence. When rates are low, it often signals that the economy is stable or trying to grow. People feel more secure in their jobs, more optimistic about the future, and more willing to make big purchases, like buying a home. When rates are high, it can signal inflation control or economic uncertainty. Buyers and sellers alike may hold back, waiting for a better time. This cautious mood can slow down sales and cool prices. You want to know how beginners can stay informed in this market? Please follow me carefully. Understanding these effects is one thing, but staying up to date is how you make smart moves. Here's how. 1. Follow central bank announcements. For example, in the US, watch the Federal Reserve's updates. They often hint at future rate changes. 2. Check mortgage rate averages weekly. Websites like Freddie Mac, Realtor.com, or your local equivalent publish rates regularly. 3. Read local housing reports. Your city or state real estate boards often release monthly data. 4. Use mortgage calculators. See exactly how a small rate change affects your monthly payment. 5. Follow trusted real estate channels. Subscribe to experts on YouTube or podcasts to hear simplified updates. Interest rates might seem like a boring number buried in financial news, but they're one of the biggest levers that move real estate prices. If you understand them, you can time your buying or selling decisions to save thousands, or make thousands. Conclusion and call to action. So next time you see a headline about interest rates changing, you'll know exactly what it could mean for your dream home or investment. If you found this video helpful, hit that like button, subscribe for more beginner-friendly real estate tips, and drop a comment telling me what mortgage rates are in your country right now. Let's compare.